Okay, ladies and gentlemen, welcome to the 2023 Planet MicroCap Conference. This is the resource track, and opening the track we have Treasury Metals advancing the Goliath Gold Complex in Ontario. The company just under a month ago released their pre-fees, and here to talk about the story is Oren Baranowski, and take it away, Oren.
Thank you, Misha, and thank you to Planet MicroCap for giving us the opportunity to come and present to you today on the Goliath Gold Complex. So we're in Northwestern Ontario looking to develop one of the next gold mines in the province. We'll take you through 2 pages of forward-looking statements and cautionary notes. They're also available on our website for you to read at your leisure. So why Treasury Metals? We own 100% of the Goliath Gold Complex. We're located in Northwestern Ontario near the town of Dryden. We've got access to world-class infrastructure, which we'll get into in more detail. And we also have a federal EA for the project. So we already have the federal permits in hand for the Goliath deposit. Over the last 2.5 years, there's been a complete changeover in the management team after we purchased the neighboring property. That's brought in a development and construction focus to the team, and we have the capabilities to move the project forward through the different studies and all the way into production. We just put out our PFS. We press released it in February, and then the technical study was filed at the end of March. Showing a $336 million NPV, 25% IRR at a $1,750 gold price. And if you use the current prices today, you're looking at an NPV north of $500 million and an IRR above 35%. We updated a resource in 2022 for the PFS that showed about a 10% increase in measured and indicated and about a 50% increase in inferred resources to about 3 million ounces. So we have the resource base to build the project and to move it forward. But the project, the property package is also relatively underexplored. So we think we've got a lot of opportunities to continue to grow that resource to find more higher grade ounces. And then finally, we have a pretty strong financial position. We did a financing in 2022 that raised $20 million and we finished 2022 with about $16 million. So well funded to take us through into the feasibility study and towards, we're looking at project financing to build the mine. Through our capital structure, so we're traded on the TSX, ticker symbol TML. We also have an OTCQX listing, TSRMF, and we're also and listed as well in Frankfurt, TRC1. About 143 million shares outstanding at a 31-cent share price. So for about a $45 million market cap, relatively clean capital structure, not a significant number of warrants and options, RSUs outstanding, giving us about 173 million fully diluted share count. The ownership structure is about 50-50 split between retail and institutional. The retail's roughly half of it would be North American based. The other half would be in Europe in high net worth family office money. And then you see First Mining on there as a 14% shareholder. That came about from the acquisition of the neighboring Goldlund property. So they own 40% of the company at one point in time. And then there was an agreement to take them below 20% within 1 year of the acquisition. And that happened in the summer of last year. And they've diluted down with some equity raises that we've done over the past year since then to take them down to about a 14% shareholding. We do have 4 analysts covering us, all Canadian-based, all with buy ratings on the stock, and I think the average target price is around $1.20 or so. Let's talk briefly about the management team. Jeremy Wyeth, our president and CEO, he's about 40 years of industry experience, 25 of that with Anglo and De Beers, building mines across 4 different continents for them. The last one that he built was the Victor mine in Northwestern Ontario, at the end of a 400-kilometer winter road. So we'll get into a bit more about Treasury and why our infrastructure advantage that we have that will hopefully make this project a simpler build. My background, I came here from Stornoway. I was the CFO of that, and then also helped raise $1 billion to build the Renard mine. 25 years of industry experience mostly on the financial side of things. Rachel Pino, our VP of HR and Sustainability. This will be her 6th or 7th mine that she's taken from a small complement of people up to a full operations. So she understands what's involved with taking a company from concept stage all the way through into operations. Stephanie LaBelle, she's negotiated probably 60 agreements with Indigenous communities in Ontario, both working for the communities and also from the corporate side. So understands the complexities of negotiating these types of agreements. Adam Larson, our longest serving employee, he's our head of exploration. About 10 years of experience with the company, so really understands the geology of the project. And then Zahir, our manager of environment and regulatory affairs. He's permitted multiple mines in Ontario and across the world. So getting into the regional picture here. This is a gold belt, more than 60 million ounces of gold historically produced in Northwestern Ontario. And there's probably about 40 million ounces of NI 43-101 compliant ounces. So this is a prospective area that we're in. We represent about 3 million ounces of that total. Drilling down into our property package, you see the Goliath deposit at the southern end of the property, Goldlund in the middle, and Miller towards the northeastern end of the property package. You see that we're about 15 kilometers from the town of Dryden, and then Sioux Lookout is about 10, 15 kilometers from the northern end of the property package. Provincial Highway 72 runs along through the property package. You'll see the Trans-Canada Highway along the bottom of the southern end of the property package. The rail line, the CP rail line that delivers equipment to, there's several mines that are being built in Ontario. Those all come across our property package. We've got a hydro line that all we'll need to do is put a substation in. So we have, access to world-class infrastructure right at our doorstep here. Wouldn't be complete without showing a picture of Tim Hortons. You go to the airport in Dryden, you land, you drive past that, you stop at Tim Hortons to get your coffee, and then 5 minutes you're at our project site. So when you're looking at ways to de-risk projects, infrastructure is key. I spoke to Jeremy's experience in building Victor. 2/3 to 3/4 of that was about logistics, right? Managing, shipping. You've got a 6-week shipping window that you can get goods in there. So having year-round access really allows you to manage the construction of the project better. It helps to reduce risk. Just give a quick overview of the PFS, $336 million NPV using a $1,750 gold price, 25% IRR. It's a low CapEx project, $335 million to give us about a 2.8-year payback. It will be about a 6,500 ton a day mill. So it's a very technically simple, gravity CIL, gold recoveries in kind of the 94% range for that. This is off the shelf technologies. We don't have really complex metallurgy there. It's a 13-year mine life. Within the first 9 years, you're averaging about 110,000 ounces a year, to give you a total recoveries over that mine life of about 1.2 million ounces. And in those first 9 years, you got a sub $900 cash cost, and just over $1,000 US all-in sustaining costs. Just for reference, the global average, I think in the fourth quarter was around a $1,300 all-in sustaining cost. So this gives us a really good margin to be able to operate from. The peak production of 128,000 ounces in the second year. As I said, averaging over the first 9 years of about 109,000 ounces of gold a year. Life of mine, $935 cash cost, and just under $1,100 for your all-in sustaining costs. But when we look at higher gold prices, $1,850, $1,950 gold, you're starting to get, to where you're, $500 million NPV, 33.5% post-tax IRR. Again, at a $1,100 all-in sustaining cost at a $2,000 gold price, that's a pretty good operating margin from which to work from. We wanted to segment out further the project just to kind of show the cash flow potential of the mine in the early years. So if you look at the first 5 years of operation, you're averaging about 116,000 ounces a year. The grade profile is higher in the first five years, so 1.7 grams per ton, giving us a cash cost of just over $800 US and just over $1,000 all-in sustaining cost. We generate $106 million a year in free cash flow, $145 million of EBITDA at $1,750 gold. If you bring that up to $2,000 gold where we are today, you'd probably add another $25 million of free cash flow per year to the project. So again, it really shows the potential of this project. Life of mine at $1,750 gold, just under $1.3 billion of EBITDA and $869 million of free cash flow. So the project it's a combined open pit and underground operations. So in the pre-production year, we'll be mining from the Goliath pit, and in the first year of production, then we'll move over to Goldlund and mine there for the next 5 years or so, and then come back to Goliath after that. While doing that, we'll be developing the underground mine. So that will start in year 1. It'll ramp up to commercial production levels in year 3, and then peak production of about 12 to 1,400 tons per day from the underground by year 7. We'll stop mining in the open pits in year 9, and then we'll just process lower grade stockpiles for the last 4 years of operations to give us a plant feed over the life of mine of about 2.4 million tons per year. Looking at the production profile, and I'll get into a bit more about the exploration potential of the project. You'll see the first year, 94,000 ramping up to 128,000 ounces. Then you're kind of above the 110,000 ounces a year for the first 7 years. And then you see the production decline after that. And that's where, we think some of these exploration targets that we have on our property package will be able to bring in. So we've got, from today, we've got, we'll call it 9 years before we need to worry about replacing some of those lower grade ounces. But the goal will be to continue to push out the low grade stockpiles, the low grade materials with higher grade materials. We put out our PEA in 2021, and from that, there were a few things that came out of it around, continuity of mineralization within the resource. So we did about a 60,000 meter program that year, of which 40,000 went into the resource, focused on infill drilling to improve continuity of mineralization. And I think we did a really good job in conversion of materials with that into the new mine plan. We added about 175,000 ounces to the measured and indicated category to take us to 2.1 million ounces. And then the inferred increased by about 250,000 ounces, or about 48%, to give us a resource base now of about 3 million ounces. And I think what we achieved from that exercise was that we improved the confidence in our geological models. And I think it's now geologically representative of what we have, so that when we go to start mining, the rocks are going to look like what we think they look like. The 3 million ounces that we have on the property package are really only represented in about 3 kilometers of drilling along a strike length of about 65 kilometers. So we think we've got a great opportunity ahead of us here to start exploring over this regional property package. We'll start at the bottom of the slide and then work our way back up. This is when we purchased the Goldlund property. Sorry about that. When we purchased Goldlund, both companies in the past have been relatively underfunded, and they really focused their exploration on the specific deposits and didn't look at any regional exploration targets. So for the first 6 months of 2021, we combined the data sets, put them together to give us more of a regional overview. To then start building a resource pipeline, because we had resources, but then we didn't have anything backfilling that within there. So on the Goliath property, we looked at the Fold Nose and the Far East targets. Fold Nose is about 2 kilometers from where the main processing plant will be. It has a lot of complex folding. So we brought in Mira Geosciences to come to do some geological 3D interpretations of the resource. And we did about a 3,000 meter program. And from that, one of the main hits was about 11 grams over 10 meters with a 1.5 meter at 75 grams within there. So this is looking more like a lower tonnage, high grade underground type target. And then if you move further east to the far east target, it's about 8 kilometers away from the main Goliath deposit. We've looked at, it looks very similar geologically. The geological signature looks very similar to the Goliath deposit. And just for reference, Goliath is about 1.5 kilometers in length in total. And it's about 1.1 million ounces of gold between the different categories, between measured, indicated, and inferred. We've identified about 600 meters of strike length at Far East. And one of the features of Goliath is it has this lower grade halo around these high grade shoots. And we think we've identified at least one of the high grade shoots at Far East. You know, we drilled a target that had 500 grams over 0.3 meters in a wider interval of about 17 grams over 9 meters. So we've done late last year and early this year, we did about a 5,000 meter program on both of those targets. The results will come back and we'll look at that to then, you know, look to go back later in the year to some of those. We think Far East is probably the target that's probably closest to being a resource next for us, just because of access and I think, you know, because of the similarities it has to Goliath and our understanding of the main Goliath deposit. Moving over to the Goldlund property, we've got the Wildcat targets that are north of Goldlund but south of the Miller deposit. So they're about 5 to 10 kilometers away from the main Goldlund deposit. We drilled those early last year, and one of the main hits from there was about 28 meters at a gram, very close to surface. So we'll go back to that later this year, next year, as a potential open pit target. And you know what we found with some of the deposits that on the Goldlund site, Miller as an example, it was drilled in 2018. There was about 10,000 meters in total drilled on that, and from that we got about 75,000 ounces of indicated, and there's about 25,000 ounces that are in the reserve now. So we think, you know, the Goldlund deposit will have a bunch of these smaller pits that we can look to access to mine over the life as expansion material. And then one other target, one of the more exciting targets on the property is the Interlakes. It's located between 2 large plutons at the southern end of the property. Very complex holding, so we got Mira to come in to do some 3D IP work to help us with target generation. Old timers back in the day, in the 1950s, they drilled at the very southern end of that target, and they hit, you know, half an ounce of material in shallow 30-meter holes. So, and that we don't even think that's part of the main deposit. So we're clearing some of the pathways to get in there and hope to be drilling that in the summer this year. So I think now where we are is we've filled the pipeline with targets at various stages along the way. We have rejected some targets, and we'll have a much more rigorous system now in place for exploration and looking at things on a belt, you know, on a regional scale. Okay. We've got about, you know, again, we're looking at our peers. This is, you know, North American developers. We got about 2 million ounces of gold in the measured and indicated category. So, you know, a project that you can take and build from that, but about a $50 million market cap. And I think the opportunity that we have here is from a valuation perspective. We've spent a lot of time over the last 2 years working to de-risk the project, working to put a project in place that can move forward. And I think as we can continue to deliver to the market on expectations of what the project can be, I think the opportunity for people is to move to the left of the valuation curve. You know, moving from, even if we go to an average multiple, you're looking at a 2.5 times return from where we are today. And I think if you look at where projects have been taken out in the developer space, people at the PFS or the FS stage, you're looking at, you know, something more in the 0.5 to 0.7 times P to NAV. So, you're looking at, again, significant upside for a project that also has the financial capabilities to take us through to feasibility and beyond. So we think, just to summarize, we've got a project that has a federal EA in hand. This is a sought-after jurisdiction. This is a mine that will get built, whether it's by the current team or by somebody else. Ontario is a sought-after jurisdiction, and we are moving the project forward as if we are going to build this ourselves, but recognize the realities of the market that might not be in our hands to do that. A PFS that shows solid economics at $1,750 gold, and then if you use current gold prices, and more than $500 million NAV for a project. We've got a renewed focus on exploration. We got an experienced management team that can drive the project forward, and we are well funded to take us through this year and into next year. With that, here's the contact information, and we'll open it up to questions.
Thank you, Warren. Do we have any questions for Treasury?
Oh, I don't think I need that. Yep. Miller is about 35 kilometers from Goliath, from where Miller will be about 35 kilometers from where the plant will be. We would mine sequentially. So the initial open pit operations will be at Goliath. So in the pre-production year and the first production year, we'll be at Goliath. Then we'll move the open pit operations to Goldlund, and then to Miller for a year, and then back to Goliath. Well, there is a provincial highway that runs along the property package. And we'll also look to, there's a well-established network of forestry roads as well. So we are looking at building a haulage corridor within the property package to not go on, to only go on the highways for the time that we need to. But it is provincial roads. It's a 2-lane highway. We did a site visit with investors and analysts last summer, and we drove a tour bus from Sioux Lookout all the way down, onto the exploration targets, and then down to the Goliath property. So road access is really good in here. Yes. It's about 4 grams. So it'd be a bulk. It's long hole stoping. The mine plan. So it takes 3 years to ramp up to call it the full production rate. We're right on the provincial grid, so we'll have to. Ontario Hydro runs. There's a power line that runs right onto our property, so we'll access the provincial grid. I think in the PFS we were able to there's a northern power subsidy that we get, so our cost is I think about 7 cents per kilowatt hour.
Okay, I think we are out of time. Thank you, Warren. And information's here if you want to know more about the story. And thank you very much.